Hi, welcome to discounted cash flow valuation of Apple stock. By end of this video, we will try to calculate what is the projected free cash flow for Apple for the next 5 years, and try to calculate what is the discount rate, or commonly called as WACC, or weighted average cost of capital. Then use the WACC to discount the free cash flows which has been calculated to the present value, and calculate what is the total enterprise value by considering what is the perpetual growth, and calculate what is the net debt so that we could calculate what is the equity value of Apple. Then by end of a day, we will calculate what is the total outstanding shares of Apple, then divide the total outstanding share by the equity value which we calculated to get what is the DCF value of Apple stock. And by end of a day, and by end of the video, we will also do the sensitivity analysis by trying to plug in the different numbers and figure out how the equity value of a share is changing. As a side note, I would plug in some of these numbers like EBIT, depreciation, amortization, and capex from the financial statement modeling which I built. Might be I will give you the link of that video in the description section. If you get a chance, please make sure to watch it. That will be a very comprehensive video which I built or which I made, that will give you all the information about the depreciation, amortization, capex, and working capital. If I know that video will be like 2.5 hours long. If you think that's too long to watch, you could also get these numbers like EBIT and depreciation and amortization from other paid data providers as well. Before we get started, quick note: I'm not a financial advisor, and this video is just for educational purpose, and it should not be considered as any recommendation to either buy or sell the stock. With that, let's get started. Before jumping into calculating what is the free cash flow, what is the discount rate, and others, uh, let's try to summarize what are all the different steps involved to complete this discounted cash flow analysis for any stock. In my opinion, for any discounted cash flow analysis, there is this 9 steps applicable. The first one is calculating or projecting what is the free cash flow for a specific period. Two things here: for a specific period, because by end of the day, we can't project the free cash flow throughout the lifetime of a company. So most of our models will take 5 years as a specific period, and they will calculate what will be the free cash flow for the period of 5 years which you are calculating. Second thing, I specifically mentioned unlevered free cash flow. So by end of a day, the simple understanding or simple way to calculate the free cash flow is go to our cash flow statement, calculate the difference between the cash flow from operation and the capital expenditure. That's the simple way to calculate the free cash flow. But here, since it is unlevered free cash flow, first thing, what is unlevered and why it is needed? If you recollect, or if you, the simple understanding is to calculate the net income, we also considered, or the company will also consider, what is non-operational related expenses. Non-operational related expenses, nothing but, or in majority of cases, it will be the interest income or interest expense. But by end of the day, we don't want to take that leverage into the way how we calculate the free cash flow. So that is why we'll get the unlevered free cash flow, that is eliminating the non-operational income or expenses of the company. Maybe while we go into the numbers, we will talk in detail how to get the unlevered free cash flow. Then the second step is determining the discount rate. So why the discount rate is important is simple. Say assume after 5 years, if you're generating $100, might be as of today that $100 might not be the same worth as what it has been 5 years later. Say might be 5 years later it is $100. Say for today it might be just worth of $60 or $70. So that difference, we will calculate what is the discount rate which we will consider to discount what is the future cash flow to the current or the present value. So that is the discount rate, or weighted average cost of capital, or mostly it is generally called WACC. Then the third step is to calculate what is the present value of the projected cash flow. In the first step, we calculated the 5 years or the specific period free cash flow, and in the second step, we calculated the discount rate. So in the third step, what we are trying to do is discount all the future cash flows into the present value. That is the third step. Then the fourth one is calculating a terminal value. So by end of the day, while we do the discounted cash flow, the simple understanding is the company will prolong beyond the specific period or the 5 years or 7 years period which you are going to do the discount cash flow. So in that case, what the terminal value is, even after the 5 years of period which you are going to forecast, we will assume a number at which the company will grow beyond that 5 years. Typically that number will be what is the GDP of the US economy or whatever country the company which you are valuing from. We'll take that value and try to grow that company throughout the lifetime. Then the next one is total enterprise value. This is nothing but summation of the step number 3 and step number 4 which we did before. Then the fifth one is net debt. Again, I specifically mention net debt. That is, if you go to a balance sheet of a company, they might say, you know what, we have a short-term debt of $2 billion and a long-term debt of $8 billion. Which in this case, the total debt is $10 billion, which is summation of a short-term and the long-term debt. But there might be some scenarios where they might have cash and cash equivalent sitting of $5 billion. In this case, the net debt is the total debt which they have, which is $10 billion, then subtract it with the total cash they have, which is the $5 billion. That is the net debt. Then we will get the equity value. In this case, the equity value is nothing but the sum of the terminal value plus or minus the net debt. So which gives the equity value or what is the market value of the company. If you are valuing any non-public traded company, the discounted cash flow model stops here. But most of the time, at least what I do is only the publicly traded company. That's where I get more significant data or trustworthy data. Then the next step is to calculate what is the total outstanding shares. This pretty much we can get it from their most recent 10K filings or the most recent 10K or 10Q filings, whatever it is. Then the last step is the equity value per share or what is value of per share. That is nothing but dividing the equity value, which is our step number 7 here, and divide that by the total outstanding share, which will give us what is one value of the share, and we can try to compare it with what is it trading and figure out whether it is fairly valued, undervalued or overvalued. And might be one additional step which we could do, which I haven't listed here, is sensitivity analysis. Again, by end of a day, all this discounted cash flow takes some assumption of numbers. Might be if we change one number, significantly the end value or the equity value which we are looking will significantly differ. So we can plug in different sort of number, say for WACC or discount rate, which will be the most significant number here. We can try to plug in different sort of numbers and figure out how the number changes. So this will be the 9 different steps plus one additionally I'll do is a sensitivity analysis. So by that we will figure out what is the value of the Apple as of today. Again, this is not any financial advice, and I'm not a qualified person to give a financial advice. This is just for an educational purpose. Now we understood what will be the process or step-by-step process which we will follow for the calculating the DCF value. Let's get into the actual numbers. As I mentioned, the first step is to calculate what is the free cash flow, or to be very specific, unlevered free cash flow. For this, I already did the financial statement modeling for Apple. Might be I have given the link of that video in this description. Might be in the previous video, what I did is I did an entire 3-statement financial modeling. By doing so, I have acquired or I've already calculated how will the balance sheet will for the Apple will look like for the next 5 years. So as a prerequisite to this video, please watch that video thoroughly, or please watch that video. That will give you all the nitty-gritties or the assumptions which I have took to get into this much of detail. On top of that, the previous video will have all the 3 statements, all the 3 financial statements, including the income statement as well as the cash flow statement. I know that video will be like 2.5 hours long. If you feel like it's too much long to watch it, that's absolutely fine. the other way to get the numbers which for the free cash flow, because I'm just going to use this tab or of the spreadsheet where I calculated the or fully done the financial statement model, is to just get the values to calculate the free cash flow. The other way is you could go to any other websites like FactSet to get those unlevered free cash flow. The only thing I wouldn't do that is the FactSet is a paid services, which I don't think, at least I'm not having that paid services. If you have any other paid services which gives you the information to calculate the unlevered free cash flow, you can feel free to use it. Now let's get into business. So this is the tab which I calculated the financial statement model. Maybe I'll just rename this tab and I'll create a new tab as DCF. So to start with, first step is unlevered free cash flow. So again, as I mentioned, for calculating the unlevered free cash flow, we will start with operating income, and then from there, let's go ahead. Maybe I will just put in the dates. So let me quickly see this date. When was the most recent 10K published? It is September 27, 2025. That is 27, 2025. So this is the date which Apple have published their most recent 10K. Then, as you know, Apple end their financial year by end of September. So will next financial year will be like 2026, or might be rather than this, to do it efficient, I will use this end of month function. Start date is this, and then 12, which gives me the projected date. So as I mentioned, I'm going to forecast the unlevered free cash flow for the 5 years. So I took the numbers till 2030. So this will be the pretty number which I needed. I don't need all these rows. I'll just delete these guys. Okay. So the first thing I need is EBIT. That is nothing but operating income, which we already calculated in our financial statement model. So I'm just going to link the numbers here. This is the number here. Let me do the validation. Okay. And then the next one is, even though this EBIT, there will be a tax rate associated to it. And the good thing is we already calculated what is the tax rate in the previous video. So I'm just going to use that and then calculated what is the after tax amount of EBIT. So first thing, I need tax rate, and then after tax EBIT, or in some times it's called NOPAT as well. So I'll just use this number. So tax rate, we already know from here what is the tax rate for assumed tax rate for Apple in the next 5 years. Then we can subtract this tax from this number. So now we will get what is the value of this. Might be, to be very consistent, I will use the formatting. Okay. So even though I got the NOPAT value, maybe if you followed the previous video, you could see one difference. The net income here is the same as the NOPAT value we got here. Typically, it won't be the case for most of the company, but why this in the case for Apple is the simple assumption I took: there is no other income or non-operational income for Apple. The reason also I took is, might be if you watch the previous video, the reason is very simple, or the obvious reason is, in the year of 2025, we didn't get a breakdown of what this $321 million of other income constituted of. So that's the reason I didn't take it. Even though $321 million is a huge amount, but compared to the total revenue they make, which is approximately $400 million, this number is very minimal. So that's the only simple reason I took other income as zero. But most of the cases in the time or whatever company I value others, every time I will have some other income value. Either it will be very minimal, but still there will be some value. So that's the only reason you see for Apple the net income and the after tax EBIT or no part will be the same. I still used to have this way so that it will be consistent on whatever other companies I do the valuation going forward. So now I got this value, which is no part. Then what I need is depreciation and amortization, because we wanted to add back the depreciation and amortization, which is already calculated as an expense while we get into the operating income. So I will add depreciation. I'll just put D&D. Again, we don't need to do anything to calculate depreciation and amortization. Everything will be here. Now let's come to this number and get this value. That's it. Then next one is capex or capital expenditure. Capital expenditure as well, we can get it from the cash flow statement. That is this number. And then the same will go for the next values. Perfect. So the next thing, what we need is change in working capital. That is nothing but sum of what is the change in working capital assets plus what is the change in working capital liability. Even for this, we already got this numbers here. That is working capital asset is this number. Might be I'll come back here. It is equal to sum of this guy, which is change in the working capital asset and working capital liability. Then I can just project it forward. Again, might be to summarize how I got change in working capital asset is, I'll just go back to my balance sheet. In the balance sheet, what are all the working capital assets? That is, accounts receivable is a working capital, vendor non-trade receivable is a working capital, inventories and working capital, and other current assets is also a working capital. So summation of all these four guys will give me what is the working capital asset, and the difference is nothing but what is the difference between the previous year and current year. That's how I got the change in working capital asset. And similarly, for the working capital liabilities, these three guys, which I just marked as CWL, is considered as change in working capital liability. So that is how I got those two numbers. That and summation of working capital assets and liability will give me what is the change in working capital. So now I got pretty much all the number to calculate what is the unlevered cash flow. So now I'll just do unlevered free cash flow. I'll just put it in the bold because this is the first output we need. Plus this guy, plus this guy, plus this guy, and we will project it further. Let me do a quick check here. Asset and liability, okay. Okay, the number looks fair enough. So now we concluded what was the considered as the first step. Maybe if you recollect, this is the first step, projecting the unlevered free cash flow for the specific period. This is done. Now, as a next step, as I mentioned, we need to calculate the discount rate or WACC, weighted average cost of capital. Then discount the free cash flow which you have calculated to the current value or as of today's value. So for this, let's now go ahead and calculate the WACC. Maybe I'll just do it here. WACC calculation. Maybe I know I told WACC, but let's try to understand how the WACC is calculated. So might be this formula might looks bit complex, but let's try to make sense out of it. So to calculate the WACC, which is the E is nothing. Might be I'll just fully show you. E is the market value of equity, that is nothing but market capitalization, divided by V. V is nothing but the total capital of value, that is um, what is the company's total market value plus the net debt. That gives the value of V. And rate of equity. Rate of equity's formula is nothing but the risk-free rate, that is if I go ahead and put it the money which I have to invest in the US Treasury bond for 10 years, typically US Treasury 10-year bond yield is considered as a risk-free rate. Or if you are valuing any Indian company, and you could consider what is a 10-year yield of Indian Treasury bonds. So get the risk-free rate plus beta. Beta is how volatile the company is. Might be say if the beta value is 1, which is the company is in line with what the S&P 500 index is going. If the company's value is greater than 1, say assume 1.1, in that case, if the S&P 100 is going at 10%, the company which you're trying to value is going at into 1.1%, that is 11%. That's the beta. And then market risk premium. This is how much premium or how much additional return does the investor expect by putting the money rather than in the US Treasury bond rather than buying it in the market. So this value typically it differs by a calculation to calculation, but for me I will take it as 5.5 percentage or 5 percentage, that I think will be a much fair enough value considering right now the risk free interest rate is like around 4 percentage. But I will let's dwell deeper while we get into the actual numbers. So this is the formula which we needed to calculate the WACC. Might be let me see if I can just copy this formula and let's put it somewhere in the Excel so that you don't need to switch it multiple times. So now first nothing fancy. Let's try to get in the values. That's the only thing we'll do. Maybe before that I will just highlight these numbers in different colors. No, I just need this guy, and just this guy. Just put it in a different color so I know what is the value which interests me more. Okay, so to calculate the WACC, first let's get, let me think what will be the more logical way. Let's do the rate of equity. Even for rate of equity, there is this formula. We'll just also copy paste it somewhere here. Okay. So the first value is risk-free rate. Might be what I'm trying to do is get the rate of equity. Risk-free rate, beta, market risk premium, or sometime called as MRP. Then I will get rate of equity. Then the next one I would need is rate of debt. I think that would be very simple. Rate of debt is, might be I will just put what is the interest rate, might be will come to that of then no, I'll just put a rate of debt right away. Then 1 minus t I would get it. Okay, first let's try to fill these numbers. Risk-free rate might be I'm recording this video by December 2025. As of now, I already looked into it. The risk-free interest rate is 4.11 percentage. Might be if you're doing this exercise, say later than this period, you go ahead and just do a Google search or go to Yahoo Finance and figure out by the time of your valuation what is the risk-free rate. For me, 4.11%. That's simple and straightforward. Next, to get the beta value, might be I will do one small thing. I wanted this to be dynamic enough, so I'll just type in Apple stock ticker symbol here. And if you have Excel of the or the Microsoft Office premium version, if you go to this data, there'll be this ticker symbol as stocks. Might be if you just hit it, you could see the Apple. I just typed this ticker symbol, it changed to Apple. So I'll tell you why it will be helpful. So now rather than I going and typing or figuring out what is the beta and coming and typing, and each and every time I need to go back and update it, rather than I'll just pick the sticker symbol and just give the beta value here. This will give me what is the beta value of Apple, so that it will be more dynamic. But if you don't have this version in the version, I mean this feature in the Excel which you're using, that's absolutely fine. You could just copy paste or just type in from the Google search which you're getting. Then market risk premium. This is additionally how much premium or how much return you as an investor is expecting. Might be this will be one of a most significant number which determines what is the market value or the equity value of a share. But for me now, I'll just take, say I'm expecting 5% more premium than what the market is giving me, which is 4.1%. Then I will get what is the rate of equity. So rate of equity is risk-free rate plus our beta, which is this guy, into market risk premium, which comes up to around say 9.56%. And if you as an investor, the expectation is you will get around 10%, I mean 9.56% as a return. But if you think, you know what, this number is too low for me, I would need like say more return. Say if I just change from 5 to 6, you would get around 10.6%. Or if you change it from 6 to 6.5, whatever it is, you would get the higher the return which you're expecting. But for me, I would like to keep my analysis conservative, so might be I'll just make something close to 10%. In this case, I will still stick to 5%. But as I mentioned, we will do the sensitivity analysis where I will try to give more return and then figure out what would be the equity value of the Apple. Then next one is rate of debt. I think this is the most. This I'm going to take a very wild guess. The reason is very simple. The exact way to calculate is go to Boomerang or any data provider, figure out what is the yield to maturity interest rate. That will give you at what rate Apple has borrowed the capital from the from the lenders or bank. But since I don't have the Boomerang, and might be some of the people might also watching, you don't have the subscription because it's a premium subscription. What I'm going to do is, ideal way, the second option which we can do is go to the Apple's annual report, figure out what was the interest expense, and divide that by total debt they had, which will also give you one rate of debt. Even though it might not be the very accurate one, it will be close enough. But the beauty is, in the most recent annual report, even we don't have the interest expense number. So what I'm going to do is, as of now, the interest rate is around 4.5%. I'll just even be more conservative and assume the rate of debt at which Apple is getting all the interest is 5%. Even though this number, the actual number, if you look at, will be very less than this, because when I did the analysis in 2023, or by looking at the interest rate in 2023, it was just around 3.25%. Maximum it can be at 4%, but I'm assuming 5% for this exercise. So now we got rate of equity, we got rate of debt, tax rate we will get it, and the next two items is the debt and the E is nothing but market cap. I'll just delete this row. Just put it in a different color. Okay, and now I'm just going to get market cap. Market cap is nothing but, in our case, EE, which is nothing but equity. I'll just go do this and get the market cap from here, which will update dynamically. It says 4.139 trillion, which is almost the same. There's nothing difference. Then I don't know why it looks like this, but market value is E. Then what I need is debt, or again, to be very specific, I need only net debt. So net debt, what I do, I'll go to my most recent annual report, or if you get any most recent either annual report or a quarterly report, I go to the balance sheet. or even might be if you already did the financial statement model, you could just come here and okay, might be sometimes it will also differ. Nevertheless, you can just go to the most recent annual report or quarterly report and figure out what is the total debt. For this, come to the liabilities. In the liabilities, uh, long-term debt Apple has mentioned as 78.32 billion. Then in the current liabilities, they have mentioned their short-term debt is around 12.3 billion, plus their commercial paper is 7.9 billion. So let's add all these things to get what is the total debt. On top of it, Apple also mentioned in the most recent year they have approximately $35 billion sitting in cash. So to get the net debt, we'll get what is the total debt, that is summing of all the debts in the liability and taking a difference with the what is the total cash. So let's do that. Might be for this, what I'll do simply is I will add two columns. First one is total debt, which is summing up those three numbers. In this case, 78,328 plus the term debt is 12,350 plus the commercial paper is 79,79. Then I have cash. Cash is 35,394. 35,934. My apologies. Okay. Now we will get what is the net debt. Net debt is now nothing but the difference between this guy and this guy. So now we got what is the debt as well. So might be just do the formatting so that it looks. No, I don't need this numbers. Okay. So now I think to calculate the WACC we had pretty much everything. So we have, yeah, the final thing, maybe I'll just to be very clear, this is total debt is D, and V, as you could have seen, V is nothing but summation of E plus D. Again, to be very clear, I'm using a difference, even though the value says E plus D, by end of the day, we have net debt, which is the cash which the company need to pay out. Even though their market, even though their market cap is around $4.1 trillion, they still have $62 billion. So I'm just do this to get what is the value of it. So now let's go ahead and plug all this number and get the WACC value. Might be even to be very clear, I will break it down. I'll calculate E by V number here and then D by V as a separate number, then just multiply it together. So E by V, that is nothing but equity by total value, which is this guy divided by this number. Okay. And then the debt by this one, which is equivalent to debt is this guy by this guy. So these two numbers I would have it in, let me think. Okay, I think it's better let me have it as it is. So no, let me do one thing. Let me have these two guys as a percentage, because the rate of equity and everything is in percent, so I will also convert this into a percentage. Okay, even though this is 0 percentage, might be there will be some value to it if we increase our number. It's like very minimal. That's the debt they have, because in comparison their market value. Okay, I think I now knew what is the mistake I did. Okay, never mind. I think I understand the mistake. So if you see here, all the values which I got from this spreadsheet is everything is in millions, whereas the market cap which we got is in trillion. So we need to make sure this number is converted into a trillion. I mean, the market cap here is in trillion. We need to convert that into million. So for that, what I'll do is I'll just divide this number by 10 power 6, which will give me this value in $1,000,000. So now this will be the most accurate number, which we would take it further. Now these two numbers make sense. No, I think still I have some. Oh, okay. I think this should be plus. Okay. Now this looks fair enough. So now let's plug all the numbers here in this WACC formula to get this final thing. So we know what is E by V, which is this number, multiplied by rate of equity, which is this number, plus 1, sorry, D by V is this guy, multiply it with rate of debt, and multiply it with 1 minus the tax rate. Might be the most recent annual reports or quarterly reports tax rate. Since mine is annual report, I will just go here and plug in the tax rate. Tax rate is this guy. There is a small, yes. So now this gives me a WACC of 9.4812%. So now our second step of this process is done, that is calculating the WACC. So now we completed two steps. In my opinion, these are the two time consuming process, but we completed it successfully. So the rest of the items should go in quickly. So the third step is calculating the present value of projected cash flow. That is, we are saying that by 2030, Apple will generate $181 billion in free cash flow. But as we are doing the valuation now, we need to know what that $181 billion after 5 years is worth now. Might be, just to be very clear, I'll just put a note, all dollars are in millions, so that very clear or no confusion. Okay, so now what I'll do is present value of unlevered, just present value of unlevered free cash flow. So I will do this one. So might be I will just add one row here as valuation date, because I'm doing the valuation today, so I'll just put today's date here. Then, oh sorry, I think I messed this up. I'll just first copy paste these numbers. Okay, I'll do today. This is valuation date. Might be even tomorrow if I come in and I'll just open, the date will update accordingly, so I don't need to do any gimmicks here. So I'll just copy this guys and paste just as a numbers. That's it. Okay. So now to calculate the present value, the formula is very simple. We have, say, 130, I mean $181 billion as a free cash flow in 2030. We need to divide this value by 1 plus the discount rate which we calculated. In our case, it's 9.48% to the power of how much period it is from here on. Say right now we're sitting in 2025. It is 5 years from now, so it's 5 years. So maybe I'll just put that formula as well here. So present value is equal to the free cash flow of the year by 1 plus WACC to the power of n. N is nothing but the year. So I'll just put year as a number here, because by end of the day 2026 is 1 year, 2 year, 3, 4 and 5. So this way we could just do the power of this number and get what is the present value. Now I'll do present value of free cash. Okay, so this number is going to be by 1 plus the WACC. I will do the fix to the WACC because it will going to be the constant to the power of this one. And now I'll do one more thing. I will format it in a proper way so that okay. So by doing this exercise, we could figure out, say, no, as we calculated, $181 billion in 2030 is valued only $115 billion as of today at a discount rate of 9.48%. Might be now a very crucial part of it or very a minor thing, but it makes a lot of sense to have it working. If you look at the power to the 1, might be while calculating the year, I calculated it as a whole year. That is, we are going to get all the cash flow by September 30 of 2026. But already we are like say 2 months passed into it, because our as of today's date is 5th December, and we just have only say 10 more months rather than 12 months of time. So what it makes more meaningful is calculate or divide do the discount of the free cash flow from the current date rather than the previous year's annual report date. So what it means is, rather than just doing it one, calculate the difference between these two numbers and then divided it by 365. This will give you a number. This is the most accurate number which we need to use rather than just using the whole number. Might be here I will just do dollar for this and then I will just project it all. So again I will just do this formatting. Then one more thing which we need to consider is, for the year 2027 all the way till 2030, it makes sense to take the full free cash flow which the companies expect to generate. But for the current year, we are already like 2 months passed into it. So I wouldn't consider entire 130 billion will be generated. So only that 82% of it will be coming out of it. That's the assumption I'm going to take, which is this number multiplied with this number will give me this number. Okay. So now we got what is the present value of all the cash flow, which is step number 3 here is done. Now the next step is terminal value. Again, why terminal value is needed? That is because we only calculate the let me see, something is wrong here. I think the formatting is wrong. Okay, I don't know how it happened. Okay, terminal value might be why we need is, we are calculating only the free cash flow for the 5 years, but our assumption is whatever company or enterprise you are valuing, that will last longer than 5 years. So we need to take one common number or a rate at which we assume the company is going to grow. So for this terminal, there is a typo. So for this, what I would do is perpetual growth, which is I need to take an assumption on how much the company will grow till the entirety after this 5 years. As a general practice, it is best to take whatever company, whatever the country's GDP is. So this is a US based company. I would take the GDP growth, which is typically around 3.25 to 3.5 percentage. So I'm just, to be conservative, just taking 3.25. Then we need to figure out what will be the perpetual free cash flow. That is, multiply this number, that is the 2030 free cash flow, by this perpetual growth. We'll do that. Free cash flow beyond 2030, which is nothing but 2030 FCF into 1 plus G. G is nothing but this growth rate. I'll also put the G number here. So now this is this one, no, this number multiplied by this guy. Now what we did is we calculated what is the free cash flow beyond 2030, and let's calculate what is the terminal value. Terminal value is nothing but divide the free cash flow beyond 2030 by the difference between the WACC and the growth rate which we assumed. Now this number seems too high for whatsoever reason. 187. Okay, this number makes sense. Terminal value. Now we need terminal value is the company's value at 2030. What is the what is the value, free cash flow, total free cash flow which the company is going to generate beyond 2030 at the value of 2030. But now we need to understand, as of today, what is this number valued at. For this, we will calculate present value of terminal value, which is divide this number by 1 plus the WACC, which is a discount rate, to the power of this guy, which will give you some number which is around 1.94 trillion present value of terminal value. Then we will calculate sum of present value of unlevered free cash flow, which is nothing but sum of these 5 guys. I'll just do this formatting. Perfect. So now by end of the day, what I need is the terminal value. The terminal value is nothing but summation of these two numbers, that is the sum of present value of all the free cash flow plus the present value of terminal value. So with this, the step number, I think 4 is done. Sorry, I think this is the total enterprise value. My apologies. Total enterprise value. Okay. This is done. Then our next step is calculating the net debt. Net debt, I think we don't need to do much about it because we already calculated it while we did the WACC calculation. So we can just reuse that number here. So if you remember, we had the total debt value and the cash value here, and what is the total debt or the net debt. Maybe to be very clear, I will put it as total debt, cash, and net debt. Might be I will just mention as a side note for me, source is 2025 10K. Might be if I get the most next quarter update, I will come back and update this number. So for this, I just need the total debt, which we already know from here, this number. Then the cash is this number. Then the debt is this guy plus this guy. Sorry, this guy minus this one. Okay. So the total debt which the company has is this much. Okay. Pretty much we are almost there. We calculated net debt. Then finally the equity value, which is nothing but total of or summation of the debt plus the enterprise value. Then the next number, final number we need is equity value, which is total enterprise value, net debt, and then equity value is this number and then this number. Now it is just summing up these two guys. So we finally got this number. Might be if you could note, there was a small change in the numbers happening. This is might be due to the WACC which I have calculated and the way I have updated it. Like it updates dynamically. If any change in data happens, it updates. So that's why there is a small change happening through. So pretty much we are here till the equity value. Might be if you are valuing any private company, the step is done. As I mentioned, since Apple is a publicly traded company, we have two more steps to go. That is outstanding shares. So we will go ahead and calculate outstanding shares as the next step. So for this, you just go to the first page of the most recent 10K or 10Q. You would see the last line as shares of common stock issued outstanding as of October 17, 2025. So as of this date, as of the most recent information from Apple, this is the number we have. So they have mentioned approximately they have billion, 14.7 billion. But to be very clear, whatever number we use it only in the millions. So put that number again in millions. So we need to divide that by 10 power 6. So 14 point or 14,776 million. 14,776 million. Very sure about or be very clear whatever numbers you are doing, make sure you are putting the right unit, because all the numbers which we did in the DCF are in millions and this number is not in millions. So we need to convert it, or else you could see some numbers which doesn't even make sense. Pretty much I can just divide this number by the total equity to get what is the total or equity value of share. But if you think through a very minute nuance, Apple will also give more stocks as restricted stock as a compensation to employee. Maybe since I already reviewed this, I'll just let's see. Okay, restricted stock. Okay. If you could see, there is one footnote which says share-based compensation. Here it says what is a restricted stock unit, and balance as of September 27, 2025 is 151,574. It's in thousand. So typically 151 million. So what we also need to consider this number to calculate what is the outstanding share, because if you remember, we already calculated what is the outstanding share here, which is 14776, and if you compare this number against the outstanding share which we got, oh, we didn't get the outstanding share. Might be if I want to show you, I'll just do this one by outstanding shares, outstanding share. 14,776 is the same number which we saw in the Apple 10K report. But by end of the day, what we need to know is what are all the other stocks which can be diluted. In this case, it is RSU. but there might be multiple other scenario, like they could have options on others, but those informations are not available in the Apple's recent 10K, so I'm assuming only RSU is available. So I'll just take the RSU, which is restricted stock unit, then put that number. It is 151. Please make sure it clearly says 1000, so we just need to divide by 1000 to get into millions. Don't divide this by 10 power 6, that will not make any difference. So now we get what is the total shares, which is this number plus this number, and we now know what is the total value of shares which Apple have. Then the final step, equity value per share, that is value per share, divide this guy by this guy, which is 163. By end of the day, this is the number we are waiting to see. As per our calculation, we are seeing $163.93 as the fair value of Apple per stock. This is based upon all our assumptions. So now, one more thing, if you remember, or if you watch the entire previous video how to get the financial statement model, I had this option to switch from street case to bull case or bear case. If you closely note, right now for the street case, our expectation of net income in 2026 is 122 billion. If I go it from street to bull, it changes from 137. So since I am tying this number directly into calculating the free cash flow, typically our equity value should also change if we switch it. Say right now for the street case, one value per share is $163. If I switch it from street to bull case, you could see it says 179 billion. So this is also one thing, since I already linked the financial statement model to this, I don't want to do any lot more work to get what is the value here. So this concludes all the 9 steps which I have mentioned. As a final thing, I'll also do the sensitivity analysis. Sensitivity analysis is consider pick up two numbers and figure out if we plug in and change how the numbers will look like. Maybe I'll show it in a much simple way rather than talking a lot. So for this we need to create a data table. I'll just put this as, I'm thinking how to do sensitivity analysis. So what I need to sensitize, maybe we need to figure it out. If you see, I will take two numbers, perpetual growth rate. Right now I have considered perpetual growth rate as 3.25, which is more standard. But if you think, you know what, 3.25 is too less and the GDP will grow at 4%, let's see how the number change. Now, if you recollect, that equity value of share is $179. I'm just changing it from 3.25 to 4%. Our value shot up to $200 per share. Similarly, someone could argue, hey, you know what, even 3.25 is too high, just consider 3% as a perpetual growth rate. Then the stock value came to $173. But for now, I'll just keep it 3.25. And there might be other scenario where you could come and argue specifically on the market risk premium. The market risk premium 5% is too low. I want more return from the stock. Say I would need like 7% of market premium. Then in that case as well, if you could come back and see, the stock price went drastically down. So I will take two variables. One is the market risk premium and another one is the perpetual growth rate or the terminal growth rate, and do the sensitivity analysis. Might be you could pick any two other values and do the sensitivity analysis, but the procedure will be the same. I will start doing that. So I would take this one and do market risk premium, MRP. So we have assumed market risk premium as 5%. So I will put that 5% here. Then I will go back I will do the both side, more than 5% and less than 5% as well. Say I'm taking two scenarios, 4.5, 5, which is the actual value I taken, then 5.5 and 6%. Now let's plug in all these numbers. Then the next one, as I mentioned, I will take is terminal growth rate. Terminal growth rate, which is G. I would put this here. So now here I have considered as 3.25%. I will put that in here. Then what I would do is consider it is going to grow more. That is, the expectation is 3.25 is less. Someone says, you know what, increase that number. I'll just consider 3.75, but 3.75 feel will be too high. Let me think what can be the most reasonable value. Okay, I'll just put then 3.5% or 3.6%, 3.95%. There is no hard rule. You could take whatever number you might be, but put what makes more sense. It doesn't even make sense if you just put 6% as terminal growth, then it'll be like, won't even make sense to calculate anything further. So no, I'll just put, to be on safer side, 3.5% and 3.75%. On the lower end, I'll put 3% and 2.75%. So what I'm going to do is I'm just going to sensitize by plugging in these many different terminal growth rate and market premium into this number. And what I need to sensitize is this guy, value of a share. Now to this, I'll go to data table, not here, and data table, row input cell. What is the row? Row here is market risk premium, which is this number, and then column input is our terminal growth rate, which is this guy. Now you could see bunch of numbers. I will just do a quick formatting. Perfect. So I will also do this thick borders. Maybe I don't want to do much formatting, but by end of the day, what you could see is, if you assume the terminal growth rate will be 3.75%, and you're expecting only the market risk premium of, or market premium of 4%, it makes sense. The value is 230. I mean, per value of Apple share is $239.2. On the other hand, if you expect say 6% premium, and even though you assume the terminal growth rate is only 3.75, the current fair value is only $161 per share. Similarly, you could see for multiple variation. Again, you could do the sensitivity analysis for multiple combinations and figure out what would be the fair value for each and every case. But for now, I will stop this video here, since I got what is a fair value and what is the market risk premium. Again, to conclude, this is not a financial advice to either buy or sell, and I am also not qualified to it. This is just for educational purpose only. One final ask: if you like this video, please consider liking this video. If you have any questions or comment, please feel free to comment it or email to me. And if you like to see much more of this video, like doing the financial statement model or DCF, or even to a matter of fact trading comps, please let me know which company you would like to see next. Thank you and take care.